Hello traders, we continue to make a good educational content. In this lesson we will talk about an order block. This topic is very important because lots of trading setups are closely related to the order block. Let's figure out what it is. So, an order block is a zone where a market maker accumulates or distributes his position. In fact, we don't really care about it. It's more important to understand how to use it. An order block is a candlestick with small wicks that starts an impulsive movement, and this impulsive movement must engulf the order block. The order block will always be the opposite color to the impulse. In this case, if the impulse goes up, then the order block is red. If the impulse goes down, then the order block is green. It happens this way because there is a maximum number of sales in order block, and these sales are bought off completely. After that, there is an impulse upwards. In fact, the buyer's strength is shown here. Here is the opposite. There is a maximum number of purchases and they all are pushed through by the seller. Here the seller's strength is shown. How do we use the order block? Of course, we cannot guess whether the order block will be formed beforehand. We can see the order block after the impulsive movement is formed only. And our task is to enter the position on the test of this order block. So, we see the order block, then there is an impulsive movement. After we have a correction and we enter a position on the test. The same situation is here. The order block is formed, then there is an impulsive movement and we understand that the price plans to move down. Then we have a correction to the order block, and after it moves down. If a market maker accumulates his position like here or distributes it like here, he will control and protect this zone. And there is a high probability that this order block will not be broken through. That's why we can always take a position from the order block. In this case, to continue the fall. In this case, to continue the price growth. We can enter a position from different zones of the order block. We need the Fibonacci tool with 0.3 level. To enter a position, we can use a touch of the order block, 0.3 zone and 0.5 zone. We can put a limit order in all these three zones, and we put a stop limit under the order block. The same situation is here. We can use a touch of the order block, 0.3 zone and 0.5 zone to put limit order here and stop limit above the order block. It's very important to draw the Fibonacci according to the trend movement in order to find 0.3 level correctly. If the price goes up, we draw it from the bottom up. Here the price goes down and we draw it from top to bottom. Now the 0.3 zone is correct. You should understand it's a base and there can be some peculiarities about the order block. And it can be broken through, but we have to start with the base and learn how to find order blocks. Also, there can be test and retest of the order block. In other words, the first touch and the second touch. On the third touch, there can be a breakout of the order block. That's why we can take a position only in two situations. After a test and after a retest of the order block. If there have been two tests of the order block already, this order block is not valid for us anymore. Let's see how it looks on the chart. Order blocks can be on any chart. The higher time frame, the stronger the level. At first, it's important to find order blocks on a high time frame, and then order blocks on a lower time frame. For example, it's a 4-hour time frame, and let's check what order block we have here. It's important to find the right candlestick without large wicks. For example, here is the order block, but there are wicks also. We need to check another time frame if there is an order block with smaller wicks. 6-hour time frame, and we see that there is a fine candlestick. Here it is. And further we have an impulse. Here is our order block. We mark it with a rectangle like this. For our convenience, I will mark the order blocks in green if we plan to buy from them. And I will mark the order blocks in red if we plan to sell from them. Here we have another order block and the impulse after it that engulfs the order block. Here is one more order block because it forms the impulse too. Let's find order blocks which form the impulse downwards. Here we have an order block that starts the impulsive movement downwards. There are wicks and we can try to find better candlestick, but actually this one will suit us too. If you look at the chart, you can see many other blocks, here and one more other block and so on, but we need other blocks in definite places only. The Fibonacci retracement tool can help us with it. Let's choose an atom chart, for example. First, we decide on a trend. Then drag the Fibonacci. And then we look for a 0.5 zone or an optimal trade entry zone. And in these zones we find another block. In this case, we are satisfied with this one. And as you can see, the price has pushed off from it. In fact, we can enter a long position here with a stop limit under this order block or under this wick, it's up to you. The candlestick that forms the impulse, then a pullback, test, and an upward movement. In this order block, we can place a limit order in 3 zones. The first touch of the order block, 0.3 level or 0.5 level. Here you must decide for yourself what zone you choose to enter your position from. What levels are comfortable for you? You can choose the exact zone or you can combine all of them in your trading. Also, you should decide whether you are satisfied with the mathematical expectation if you use such an entry. We will talk about it later. It's not the theme of this lesson. In fact, in the beginning it doesn't really matter. More important to find order blocks correctly and to enter a position somewhere here in this area. If your limit order isn't opened here, don't worry. We skip it and then we enter our position from another order block. Here is the same situation. We drag Fibonacci, we find 0.5 zone and an optimal trade entry zone. Find a good order block, for example it's a 4-hour time frame, and here is a fine candlestick in the optimal trade entry zone. We mark it and draw the Fibonacci. And you can put your limit order to enter zone you prefer. The price has pushed off from it and made a high. Then the same thing, we use a Fibonacci to find a 0.5 zone or an optimal trade entry zone. Then we look for a better order block on different time frames. Here's the order block, but the price hasn't even touched it and probably we've skipped such positions. Let's see the next impulse. Drag the Fibonacci, find a better order block in the optimal trade entry zone on different time frames, mark it. And as we can see, the price doesn't touch it too. Here the price moves away from other zones. But in this lesson we are discussing order blocks only, and only order blocks are our points of interest. Other points of interest will be considered in other lessons. Now let's see the green order blocks. We use them to enter our short positions. It's a Solana's chart, 45-minute time frame, there is a downtrend. We mark the high and the low and drag the Fibonacci. In this case, the price doesn't get an optimal trade entry zone. And here you can decide for yourself whether you want to trade from 0.5 level or not. You may decide such situations and always enter your positions from the optimal trade entry zone only. Let's keep it and go to this part of the chart. We draw the Fibonacci and there is an order block in the optimal trade entry zone. The price has come to it, pushed off and made a lower low. Our stop limit should be right after this order block. Again, your limit order can be either on 0.3 level or 0.5 level, or on the very beginning of the order block, as you wish. By the way, if you look at this part of the chart, the price has given a pullback to the optimal trade entry zone here too. And here is a small order block as well. There is a series of order blocks. And the price can come to this one and this one and this one too. And you should understand that sometimes it's not possible to enter a position because of order block only. In some cases, we need to wait for some other confirmations. Sometimes the situation can be unclear and we cannot be sure what order block is more valid for the price. In such cases, we need to combine different instruments for analysis. We wait for the price to come to the order block. It's our point of interest, and for example, here it makes a break of structure. We will talk about it later. In this case, this order block and this order block are interesting for us. This order block is of less interest because it has been tested already by this order block. So, these two order blocks can be valid. The important thing is, it's better to put our stop limit a little bit higher or lower than the edge of the order block. Because as you can see here, sometimes the price can flow out of the order block a bit. And if our stop limit is exactly at the edge of the order block, then we lose. Also, there is a confirmation here that the price will go down in the future, but this is not the topic of this lesson. Now we know about the order blocks in a trend movement, so let's see the order blocks in ranges. This is a range on the MATIC chart. In ranges, we are interested in such order blocks which are situated right under the range or above it. So here is a range. We have this order block under the range, and there is the order block above it. It doesn't look good here, and you have to find better ones. I just don't want to try different time frames right now because then this order block will change. At the beginning, it's important to look for ideal order blocks trying different time frames. Of course, you may find good order blocks not always, although you may understand that the price would probably start upward or downward from this zone. Most likely, these order blocks will stop first deviations. As you can see here, the price touched this order block, then it comes inside it. Here is the same situation. The price is inside the order block, and then there are some touches of the order block and so on. And the range is formed between these two zones, and they are of a special interest for us because we understand that these deviations can come here, and we can enter a position here. But these positions are with more risk than if you enter a position after the price comes back to the range and retest it. That's all about the order blocks. Subscribe to our channel, click the bell, there will be a lot of useful content about the price action and trading in general. Let's earn together.